Okay, so I'll be starting off with a panel called The Future of Royalties. We're lucky enough to have today a wide assortment of companies able to be on the panel with me, from the large and the small. Everyone has different business plans, different commodities, so I think it's going to be a really good discussion about the future of the royalty space here. So without further ado, I'll introduce our panelists. First we have Alexander Woodyer-Sharon, CEO of Empress Royalty, David Garofalo of Gold Royalty, Dave Cole of EMX Royalty, Rob Weir of Lithium Royalty, and finally Gary Brown of Wheaton Precious Metals.
Thanks, John. Thanks for having us on.
Okay, so our panel here is the future of royalties. I think everyone knows that the royalty space has really evolved over the last 20 years. From Wheaton going public, bringing on streaming, Franco-Nevada's IPO, royalties have really moved from a financing of last resort to a financing of first resort, quite honestly. We've seen it evolve from precious metals into base metals. We've seen it evolve from producers going to developers. We've really seen the whole sector go mainstream. But now we kind of think about where is the future, and that's what we want to discuss. All the easy deals have been done, and so I want to talk a little bit about first, how are you guys going to source new deals going forward? We've seen all the portfolios effectively have been sold. The large caps have done their deals. Some of the big development projects, have been funded. And so I'll put this one first to Gary. Is how do you think how has your ability to source new deals changed over the last 10 years, and where is it going to go going forward?
Sorry, what was the first part of that question?
How has your ability to source new deals changed over the last 10 years, and where is it going to go in the future?
Yeah, well, we've been around for 20. I've been with Wheaton for 16. So, interestingly enough, when I first joined, we were banging on doors, trying to convince mining companies that they should consider streaming as a form of capital. And now the roles have completely switched. So we're no longer out there looking for deals. Those deals are coming to us. So people are very interested in looking at this form of capital. I don't think if you're a CFO of a mining company and looking for capital, I think 100% of the time they're going to at least evaluate what streaming could bring to the table. And I think the form of capital that we bring to the table is one that any size mining company can subscribe to. The smallest single asset development stage company to the largest mining companies. And I think as you started off with, streaming is really here to stay.
Awesome. Dave, I want to turn it over to you, because obviously you have a different business model, and talk about how you've seen it change.
Yeah.
Oh, sorry, Dave Cole.
Sorry, you go ahead.
We'll get to the other Dave in a minute, Dave. Yeah, well, first of all, it's good to review where royalties come from. You specifically mentioned royalty financing, right? Mm-hmm. Royalties can come from dominantly three groups. There are royalties that are created when a prospector or a mining company sells an asset and keeps a royalty. And so you can go out and purchase those royalties. So purchasing of existing royalties, that's one place to get deal flow from. Mm-hmm. Another way is what we love to do, and that's royalty generation, where we're actually the prospectors that go out and acquire the prospective mineral rights, coalesce existing data, illustrate prospectiveness, sell that on to a capable party in exchange for financial terms and a royalty generation. Mm-hmm. And then the third bucket would be royalty financings. And that's what everybody most commonly talks about, is the third bucket. All of which are very important, all of which are great ways to acquire royalties, which in general are phenomenal financial instruments. Mm-hmm. And your question specifically about where are we going to find that deal flow, It's handy for us because we do all three baskets, and we can rely upon our royalty generation where we don't have a lot of competition as a source of continued deal flow, but that's building base of pyramid with that long-term discovery optionality, whilst we look for opportunities to buy existing royalties or do royalty financings. Of course, we all know, I believe all of us here would admit that it's a competitive space, and it should be a competitive space because we all know that royalties are great things to own.
Yeah, they truly are. Now I think I'll put this next one to Alexandra and then David Garofalo. How do you expect, obviously we've been in this environment, high rates, really hard for juniors to finance. As an investment banker, I'm an optimist, so I think financing markets are starting to open up a bit, which is really good to see. But we're also going to see lower interest rates eventually start to come here, and hopefully greater competition from more traditional sources. So how do you expect your deal activity to change in this paradigm that could come in the next couple years?
I don't really see interest rates going that much lower, sort of fundamental principle. And in terms of traditional sources of finance and the competition, we really are investing in public and private companies. And with private companies, they don't have access to that traditional equity or debt. And then when we are looking at public companies, a lot of them, although they as a public company have access to equity, they're so undervalued right now they don't want that dilution. So we're seeing a lot of opportunity that with producers who want a bit more expansion capital and that type of opportunity. And then if the market does actually start to reflect the true value, that's where we can go alongside with some debt, some equity, and then provide the streaming finance. And at Empress, we're very much on the smaller side of the market, so sub 25 million, the sort of $5 to $10 million investment size. Very nice.
David, anything to add on to that?
Well, looking at it from a producer's perspective, because I spent most of my career on the production side and on the mine development side, and expanding on what Gary said, it has evolved dramatically. Back in the day, streamers and royalty companies really only talked to base metal producers on their byproduct credits because there was arbitrage there. I remember doing a deal with Gary when I was running Hud Bay well over a decade ago now, and we were building Constancia in Peru, and we were trading at half times NEV. He was trading at 2 times NEV. He paid me 1 times for my stream. We both won, and they got the re-rate. But what's changed over the last decade or so, with the lack of any major discoveries in the gold business, we've seen a significant derating of gold equities. So that arbitrage that didn't exist a decade ago for the producers now exists for the gold producers today. Their cost of equity has gone up exorbitantly. And even though the markets are opening up somewhat, I'm not optimistic they're ever going to recapture that multiple. And it's disappeared because of the lack of growth and reserve discovery, but also the cannibalization of gold equity demand with the advent of the ETFs on the gold side. That's taken away an element of demand for gold equities permanently. And so I think that arbitrage is going to exist going forward. I think that's why Gary's seen a steady flow of royalty opportunities and why there's been a proliferation of royalty companies in the last decade or so. It used to be exclusively the domain of the 3 big guys in Royal, Franco, and Wheaton, and now we're seeing a whole bunch of other royalty companies filling a need that I think is going to be quite permanent.
Exactly, and I think building on that, we've seen the royalty model move from precious metals into base metals and now into battery metals. And this question's here for Rob. How do you see the market for battery metal royalties, which has traditionally been a much smaller market than the precious metal side?
Yeah, I think we see enormous opportunity. The business only started as a private equity strategy in 2018. We have 35 different royalty partners. 3 of them are producing. So I think we'd line up with Albemarle that there's going to be 300,000 tons of annual demand between now and 2030, and that's going to require 100 mines. So it's been a difficult pricing environment, but these companies are very nimble. They've been creative in how they've financed themselves. Atlas Lithium took our $20 million US last year, and they've brought in almost $100 million via convertible equity and offtake. So royalties definitely have a gap to fill, but we think the market's going to have explosive growth between now and, say, 2030.
Yeah, and I think what we've also seen is we've seen some of the precious metal companies start to diversify. I think I'm going across the stage here. I think each of you have done, maybe Alex, I don't know if you've done it, but each of you have diversified into base metals in some shape or form here. And so, I think I'll pose this question to David first and then to Gary. Do you think you guys have to focus on precious metals in this environment, or do you think your investors are willing and want to see you guys diversify? First to David Garofalo, sorry.
Well, look, I think the fundamentals for copper in our case are so strong that it's hard to avoid getting into that line of the business, and having a bit of metal diversification, I think, is a healthy thing to have within a predominantly precious metal focused company. But at the end of the day, we're looking at polymetallic precious metal deposits that we're streaming off. So in the case of Varus that we did last week, that's a silver mine. And so we're still focused on our precious metal deposits. It's part of our core competency. And what we like about these polymetallic precious metal deposits is they tend to have lower costs naturally because of their byproduct credits, and so robust economically, but also they tend to have longer lives. And so that provides a foundational element to our business that I think base metal deposits or polymetallic deposits offer more readily than, say, primary precious metal deposits.
Gary, anything to add on that? Obviously, you guys did the big cobalt deal a few years back.
Yeah. Look, I think the business model applies to any metal. I'll say that out of the gates. I think that it's better when you're dealing with precious metal, when you're taking precious metal from a base metal operation. There's more of what David referred to as the arbitrage value creation in that environment. From Wheaton's perspective, we're focused on continuing to maintain our precious metal focus, mainly because that was the raison d'etre of Wheaton, and I think most of our investors are looking to get exposure to precious metal. If they want base metal exposure, they can subscribe to some of these other streaming companies that are focused on that. But we're going to maintain a precious metal focus, and I don't see us running out of opportunities anytime in the foreseeable future.
And one of those opportunities, could be consolidation. We've seen it over the last, probably the last 15 years. The number of streaming and royalty companies really start to explode, expanding from around 10 or so. There's a wave of consolidation that happened in the early 2010s, and then there's a big gap where a whole bunch of companies were added. I think we're up to 25 or so streaming and royalty companies, different commodities and different types, but the number of companies has started to rise quite significantly. Obviously, Dave has participated in some of that M&A. But I think I'll ask this question first to Dave Cole and then to Alex. Do you guys see a need for consolidation going forward?
Well, let's review it big picture first, if you don't mind. I'm not sure I understand the word need, but first and foremost, I would say that we all have responsibilities to our shareholders to do the right thing for the long-term shareholder, right? And we all understand that the greater the scale the business has, commonly the NAV multiple increases. So the more royalties you have, the better you trade per royalty. And that's a fact that's hard to ignore, which means that very simplistically, if you can create synergies through merger, gain scale, increase NAV, that's all to the shareholders' benefit, which from my perspective means it's something we should always be considering and thinking about. But you want to marry the right companies, and you want to do so in a manner that is conducive to bettering your position for your shareholders. That's our responsibility. I'm not sure how that relates to the word need.
Yeah, need is probably the wrong term.
Not to try to grind you on that, I apologize, but it's something that prudently we should all be looking at on a continuing basis.
Alex, anything to add on that?
Thank you. It's just, everyone knows it's hard to hear with the echo, so I'm not sure if I captured everything that, the good points that Dave Cole made, but first is our shareholders, making sure there's true value in it. There's 25 companies. We all have very different strategies, or most of us have quite different strategies. So if it's 1 + 1 = 3, maybe it makes sense. But I think there's a lot of different types, again, ways investors can invest in the whole royalty space.
Perfect. And one of the things that could drive consolidation is just the current environment that we're in for capital raising. obviously when a lot of the companies were building in the early 2010s, it was a lot easier to raise money. I can remember some of Gary's big bought deals back in the day. But in this environment, it's a little harder. So I think I'll ask Rob and David Garofalo to comment on this. How do you see the current financing environment, and how does it impact your ability to grow?
Yeah, for us, or for any royalty company, I think when the underlying falls 80%, conventional means of financing are not readily available. So Atlas was a great example. The CEO owned 45%, wanted to move the project forward. We were able to do our technical due diligence and come to an agreement. He's been able to unlock a ton of value. So it's a very difficult period right now, but these things are cyclical, and we've been through a 70% drawdown and an 80% drawdown as far as the lithium market goes in 6 years. And inevitably there's a recovery. And so for lithium, you continue to see EV penetration grow. April and May were terrific months. You don't really get to read about it in the normal Wall Street Journal, Globe and Mail, but I think as long as that underlying demand continues to grow, the traditional means of financing will return, but royalties will be part of that capital stack.
And Dave Garofalo, any comments on the current capital raising environment, how it impacts?
Yeah, I agree with Rob on the capital raising environment for the explorers, developers, operators, but equally from our perspective, capital raising has to be more creative. We don't necessarily have access to traditional equity markets either, and we have to find a means to raise low-cost capital in order to realize that arbitrage opportunity when we're providing capital to the explorers, developers, and operators. So we've had to go to strategics because we're relatively small. We're a $300 million US market cap company, so not investable for some of the larger institutions. Even if they were there, the generals, frankly, aren't in the gold space or mining space, generally speaking. So we've raised money from Queen's Road Capital, Taurus. We've even used our paper to buy royalties and streams, as we did with Nevada Gold Mines recently. They've become a significant shareholder. I know David has some strategic shareholders in his shareholder base as well. And so we've had to go to non-traditional sources, but sophisticated sources of capital, people that understand the business intimately and understand how to value the intrinsic underlying value of what we're investing in.
Yeah, and I think almost each of you have a little element of that, in your capital structure. Alex with Endeavor as involvement, Rob with the private equity funds. It definitely has changed a bit, but I think your access to capital still remains, which is good. Now, another topic I think we should talk about is geopolitical risk. One of the big news events this year was Cobre Panama. Obviously, greatly impacted First Quantum, but we saw Franco have a very large impact from what happened with that asset. So I think first I'll ask this to Gary, and ask Gary, has Cobre Panama and what's happened there changed the way you look at streaming transactions at all?
Surprisingly, no. Interestingly, I think there were three things that it highlighted for us. One, due diligence, really important to really roll up your sleeves and look at and identify all the potential risks. Two, community support. Like at Wheaton, we have a well-established policy where we reinvest 1% of our net income back into the communities around the mines that we have interest in, alongside our partners. So we're encouraging our partners, and we're assisting their programs, which really helps them gain and maintain social license. And then the final thing is contractual structure. We actually bid on that opportunity, and we actually walked away from it because we could not get a corporate guarantee from InMed at the time. So I think those are three things that I think it emphasizes for us, but it hasn't changed our view of the political risk landscape and how we would approach valuing opportunities.
And I think I'll ask some other people on about geopolitical risk, and Rob, I'll turn it over to you as well. How do you guys at Lithium Royalty think about geopolitical risk?
We've been pretty conservative. I think the line we've liked to use were the ABC of hard rock: Australia, Brazil, Canada. There's so much opportunity in those three countries. We haven't had to go to some of the higher risk places in South America or Africa. So I think if you look out from today, 10 years, we're going to stay in those three geographies, absent something politically or something dramatic changing in some of the areas we think are higher risk.
Interesting. And Dave Cole, any comments on that? Because obviously you guys have probably a little bit more political risk, but obviously you have fantastic assets in those jurisdictions. So you're going to talk a little bit about that?
Yeah, this is a topic that I spent a lot of time thinking about, and I knew you were going to ask me. I mean, we're the crazy guys that went into Haiti after Preval was elected. We got out profitably, sold to Newmont Mining Corporation before things went down, but that shows that we had the adventure to try it and go. I would say, generally speaking, throughout my career, I've been quoted as saying that we believe that political risk is fully valued, if not overvalued, because we read about it in the paper every day, whereas technical risk, geologic and engineering, are commonly underrated because people don't fully understand them, and that does create an arbitrage that can be executed on in certain circumstances, but there can be some pointed events that take it the other direction. Another crazy one that we did, we went into Russia. We sold our Russian assets, thankfully, in late 2018 for a massive windfall profit. That was fantastic. Believe me, I'm delighted that that we got out in time. You know, as another example. So, you know, I've always tried to push that window throughout my career, and I will say that, generally speaking, since I was young, I've been of the opinion that the world is bettering and more accepting of global and foreign investment. To help drive economies across the world as we move from scale, as we move up in terms of, you know, people's standard of living around the world. And generally speaking, that's been the case. But there's some pointed examples recently where that's not the case, and that's unfortunate. In today's world, we need to be careful and weigh those risks. I'm not sure that's the answer you were looking for.
No, it's okay. And Gary touched on another topic, which I want to ask of Alex and then Dave, is you know, obviously the future of royalties, royalties have become so ingrained, and people think of royalty companies as really financing tools, but Gary highlighted ESG in that. How do you see the role of royalty companies and ESG going forward in terms of helping the operators, you know, with their community and engagement? And I'll put that to Alex first, and then Dave.
So sort of our 5 criteria of investing, ESG is definitely one of our principal focuses. And because we are directly investing into companies, we have that direct relationship with them. So we're very involved in what their communities' programs are, what their governance is, and the impact that they have. And we're really able to focus our investment dollars in ones that have that profile. You know, I was mentioning earlier when we invested in Peru, that's part of the Better Gold Initiative. We've invested in one recently in South Africa where they're able to do an education program, a school for single parents, for those children to be educated there. So that is very much at the forefront of our thinking and how we invest.
David Garofalo, anything to add there?
Yeah, I mean, I can give you one tangible example where we did the Borborema project financing last year. We actually put in financial incentives for the introduction of new social programs or community programs that might engender advancement of permitting, accelerating permitting on expansion projects and whatnot. So it's both altruistic from the standpoint of trying to engender social programs, but also to provide a financial incentive for development of new expansion opportunities. By and large, though, all we can do is be bystanders. You know, once you're in, and you're relying on the ESG credibility and track record of the operators. So you want to do a lot of diligence before you go in, whether it's on a third-party royalty or whether you generate the royalty yourself, like David does quite capably within his vehicle. You want to do a lot of homework on the operator's track record in that regard before you put a dollar in.
Yeah, and that obviously makes a lot of sense because ESG is such a big focus, and you know, people don't think of royalty companies and their ESG presence that much, but you know, clearly there's a lot that you guys are doing, you know, on that front, whether it's investing directly, making sure the operators are doing what they should be doing in terms of ESG, and it's, you know, I think that's good for the audience to hear that. And so my last question here, and I'll put it put to everyone, because you guys all play a role in this, is, we got a lot of investors sitting in the audience. Why should they invest in the royalty and streaming model? Obviously, each of you have different strategies, but you're all the same in that you all invest in streaming and royalty or transactions, and you all have streams and royalties. So, why should the audience focus on you guys and not the operators or, a physical ETF?
Can I go first?
Yeah, we'll go down the road here.
I love to answer this question, and it really boils down to optionality and the fact that optionality is multiplicative. And I'll utilize the example from Franco, Nevada. This was the company making transaction that made Franco. Seymour Schulitz and Pierre Lassonde bought the Gold Strike royalty out of the Reno Gazette Journal paper for about 1.6 million USD. The royalty on that gold deposit, it was a fairly ratty gold deposit in poor host rocks. Didn't look like it had a lot of upside to it, but ultimately there was a phenomenal discovery made there. Oh, and by the way, the price of gold was $300 when they made that transaction. So they've benefited from gold price optionality in a big way. They have benefited from discovery optionality in a big way, become one of the largest deposits in North America. But furthermore, the engineers figured out ways to mine underground. They didn't believe they knew how to do that previously. That's engineering optionality. And very importantly, the metallurgists figured out how to get gold out of refractory ores, which increased the amount of gold that could be recovered from the project demonstrably. And all of those aspects of optionality are multiplicative, and it put them in a situation where today that royalty has paid $1.6 billion, and they paid $1.6 million for it. And that's why you want to own royalties. And all of those things, the metallurgy, the engineering, the discovery, exploration, paid for by somebody else.
David, anything to add there?
Well, I couldn't top that, but what I would add is that there's no limit to how much you can diversify in a royalty company. I was running Goldcorp with 20,000 employees and a dozen operating assets, and honestly, I wanted less operating assets because 80% of my cash flow came from the top 6. The other ones just wasted a lot of brain power. We could run a company with 10 times the number of royalties, the same human footprint. That's the beauty of the model, among all the things that David just mentioned.
Alex, anything to add there?
I think you covered so much of it. I'm speaking at 3:45, so in about half an hour from now, and I'd love to explain how Empress can provide benefits for shareholders.
Perfect. Well, Rob, you guys are unique in that you're doing it in lithium. You want to talk a little bit about why you should do it in lithium and not buy a lithium ETF?
Yeah, I think being participants in institutional capital markets for 20 years, you see how successful the companies before. So we've tried to take best practices from observing how they've built their business, but apply it to lithium that just someone hadn't got to yet. So you have basically zero cost of production. You have 100% upside to commodity price inflation, and so that's why you see these very rare companies with 80+% EBITDA margins that can convert almost all that to free cash flow. So we're really excited to try and emulate that. And as we get more companies through to first production, that'll become more obvious that we're achieving that.
And then, Gary, you mentioned a great stat that I'd like you to repeat during our fireside chat about your average return on your transactions.
Yeah, I mean, the average return that we've generated, we put over $10 billion into streams over the 20 years that we've been in existence. We've recovered more than $10 billion already. We still have, about 60 years of average mine life underlying our asset base, and we're generating about $1 billion a year in operating cash flow today. When you add that all up, the average return that we've made on that $10 billion annualized is 17%. So 17% a year on average for 20 years running.
I think that just beautifully encapsulates the royalty model. The upside that you get for free, the potential extensions that you get, all the stuff that each of our panelists has mentioned. You don't get that with a physical ETF or just buying gold and storing it under your mattress. It's these companies that are adding value here on stage, and they can really achieve those excess returns. So I'd like to thank everyone for joining me on the panel here, and I think most of you I'll be seeing in 15, 20 minutes here. So thanks all.
Thank you, John.
Thank you.
That's an amazing Thank you.